Global markets are flat ahead of Fed minutes. The RBA board discussed a rate hike more than was thought. Aussie renters feel more confident after the budget, and we have rate decisions today in New Zealand and Indonesia. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior commodity strategist Daniel Hynes looks at how global oil demand has been dragged down recently. A key driver is Americans driving less.
It is clear to me that rising costs that people are facing these days are starting to impact their driving habits, and certainly in regions or markets like North America and the US in particular, we're seeing gasoline demand suffer as a consequence.
But first in 5 and 5 with ANZ. Global markets were mixed and broadly flat overnight as traders sifted through further comments from Federal Reserve Board members ahead of the Fed's May meeting minutes, which are due tomorrow. The S&P 500, Nasdaq and the Dow were flat at 4 a.m. Sydney-Melbourne time, ahead of earnings from AI giant Nvidia. US Treasury yields were down around 1 to 3 basis points. That followed comments from several Fed speakers that restrictive monetary policy is helping to cool demand. The Kiwi dollar was down 0.2% at 60.93 US cents ahead of today's rates decision, while the Aussie dollar was down 0.05% at 66.63. That follows minutes from the Reserve Bank of Australia's May board meeting yesterday, indicating members had a reasonable discussion about rate hikes. Here's ANZ Head of Australian Economics, Adam Boyton.
That statement in the minutes where the board expressed limited tolerance for inflation returning to target later than 2026, we were left wondering when we read that, has the bank very subtly pushed out the sort of timeline of tolerance or the degree of tolerance that they have for inflation being above the target? I think you put it all together though, and it suggests the hurdle to tighten here is certainly higher than it was in November, and the bank are probably prepared to wait and see how things pan out.
Number 2, New Zealand's Reserve Bank is widely expected to keep its key policy rate on hold at 5.5% today. What is less certain is how its commentary on inflation might evolve. Here's ANZ New Zealand Chief Economist Sharon Zollner.
It's fair to say that people offshore are expecting the Reserve Bank to pivot to a more dovish tone, much more relaxed about the outlook for inflation, given the clear evidence that the economy is cooling. We certainly think the Reserve Bank will acknowledge that, but on the other hand, we do have this awkward starting point surprise, the domestic inflation much stronger than the Reserve Bank was expecting. So our take is that that will keep them cautious for a little while yet, not wanting to give the market any more reason to price more cuts than they're already doing.
Number 3, Bank Indonesia also has a rate decision today. It hiked last month to 6.25% to support a weakening currency. ANZ economist Crystal Tan expects it to hold this time around.
Its hike last month came against a backdrop of renewed currency pressure, but external conditions have since improved. Pressure on the rupiah has abated recently, so this reduces the impetus for another rate hike. Now, BI is likely to reiterate that its policy focus is on rupiah stability. We remain of the view that BI will have to wait for the US Fed's pivot before it can consider following suit.
Number 4, Australian consumer confidence rose 1.8 points last week, with short-term confidence, current financial conditions, and the time to buy a major item, all those measures lifted. ANZ economist Maddie Dunk says the rise was driven by higher confidence among renters.
Confidence amongst renters is at its highest level since about 12 months ago when we had the previous budget. And there were a range of measures in the budget that would likely help renters with the cost of living pressures at the moment. Particularly, we did see that 10% lift in Commonwealth rent assistance. So it'll be interesting to see whether that lift in confidence is sustained in future releases.
Number 5, the copper price this week hit a new record high above $11,000 a tonne US. ANZ senior commodity strategist Daniel Hynes says the price has been pushed up by an influx of investor money.
They had started the year on a relatively bearish note, and that was understandable considering the outlook for China and developed markets at the time. But certainly demand has come in better than expected, and we are seeing ongoing supply-side issues in that market really tighten up supply.
Daniel Hynes there, and we're staying with him for a bonus deep dive interview on global demand for oil. Daniel explains why demand has been lagging, in particular, because drivers in the US are consuming less gasoline.
Outside of, I suppose, the better than expected economic data we've seen in China, the demand for oil has certainly below, I suppose, where we'd expected it to be at this point in the season. And I suspect there's a variety of reasons, but it is clear to me that, the rising costs that people are facing these days are starting to impact their driving habits, and certainly in regions or markets like North America and the US in particular, we're seeing gasoline demand suffer as a consequence. It is an important time too, with the driving season starting unofficially at Memorial Day there. So not too far away. But certainly at the moment, that demand pulse coming from gasoline, which consumes 10% of world demand, the US driver. So it is a pretty important sector and, is certainly just suffering a bit from those high gasoline prices that we've seen during the course of the year.
So on the broader economy, we're hearing that the US is exceptional and its economy is going strong. So that's sort of surprising given what we heard about the US economy being so strong.
Yeah, and I think it's gone a little bit unnoticed, but certainly, consumers maybe, being a little bit smarter, I suppose, with where they spend. Certainly, that inflationary pulse has been an issue, and we've seen the Fed talk about persistently high costs just delaying their rate cuts at the moment. And I think that's really where the rubber's hitting the ground. And look, drivers are certainly, as I said, being smarter about their use of the vehicle. But there's also other technological issues as well. I mean, the mileage that the cars are getting these days is significantly higher than we've seen in previous years. And the EV phenomena may also start to have an impact on gasoline demand as well. Certainly, the growth in sales there has been relatively strong in recent years. So that's a factor which we have to increasingly incorporate into our views on overall oil demand as well.
So we're also seeing a drop in demand in China. What's that about?
Yeah, more so on the economic side there. Chinese oil demand is driven primarily from the industrial sector. And as you'd be well aware, I mean, the EV market itself is absolutely booming there, so gasoline demand is suffering as well. But certainly industrial activity, so the consumption of diesel, distillate, the like, is being impacted by that. But, we are seeing signs of that recovering. Manufacturing activity in particular has been positive. We saw the recent manufacturing PMI push back into expansionary territory. So there are positive signs there, and it's certainly a lot better than we saw at the start of the year, but still it needs further pickup, I suppose, to reach our forecast of demand growth of around 0.6 million barrels a day in China this year.
So those two factors, the US consumer and Chinese industrial demand, are they the main reasons why the IEA has downgraded its growth numbers?
Yeah, and I think more so on the US side, Chinese demand, they had it at relatively low levels of growth in their earlier updates this year. So they did upgrade the Chinese forecast, but certainly the US has been a little bit disappointing.
Daniel Hynes there. He'll discuss the supply side for oil tomorrow. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, May the 22nd. Catch you tomorrow with all the reaction from the Reserve Bank of New Zealand's decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.